Welcome to the Stock Market Palantir. Today, we are going to talk about PLTR. Palantir Technologies is arguably the most polarizing battleground stock in the tech sector right now, especially as we're looking toward the end of 2025. It's this fascinating collision of, well, robust, almost unbelievable fundamentals meeting a valuation that seems completely untethered from reality. The central question before us today is this. Is PLTR's current sky-high valuation, trading at a vertiginous 156 times 2026 estimated earnings? Is that justified by its strategic position as the definitive AI operating system? Or are we just witnessing an unsustainable bubble, one that's entirely reliant on speculative retail flow? I'm going to argue that the market is correctly applying a necessary, maybe even a permanent premium to a truly unique asset.
And I come at it from a different angle. While I fully acknowledge the profound, even singular strategic importance of Palantir's technology, I believe the current stock price has become dangerously decoupled from its underlying economic power. We are looking at a classic momentum story, one where the stock price has priced in the next 5 years of flawless execution. And that leaves the equity poised for what I anticipate will be a swift and pretty painful multiple compression, regardless of the company's operational success.
Okay, so to anchor the bullish case, we have to look at the Q3 2025 earnings report. The numbers here aren't just good. They're defining a new echelon of software company performance. Total revenue growth was a staggering 63% year over year. But the true inflection point, the engine justifying this premium, is the explosion in U.S. commercial revenue, driven almost entirely by the artificial intelligence platform, AIP. U.S. commercial revenue soared by 121% year over year. And crucially, the defense of this 156 times valuation isn't just about the top-line growth. It's about the unique profitability profile they've achieved during this hypergrowth phase. Palantir reported a Rule of 40 score of 114%. That score, combining growth and operating margin, is a total industry outlier.
With an adjusted operating income margin of 51%, they are demonstrating operational leverage at a scale that we simply do not see in high-growth SaaS. This efficiency justifies a massive scarcity premium. They are selling the sticky, mission-critical software layer, not cyclical hardware like, say, NVIDIA, which trades around a comparatively modest 25 times forward PE.
Right. I won't dispute the operational metrics. A 114% Rule of 40 score is genuinely excellent. But we have to retain some sense of market history here. A 156 times forward PE multiple is not merely pricing in years of flawless execution. It is effectively pricing in the successful, unchallenged execution of their entire decade-long strategic plan. And it's pricing it in today. I'm sorry, but I just don't buy that this leaves any margin for error. Think about what happens if that explosive 121% U.S. commercial growth rate merely slows. Not fails, just slows to 70% or 60% as the market saturates. The market structure currently requires constant acceleration. Any deceleration in the AIP narrative will trigger a devastating and rapid multiple compression. This level of speculation is why sophisticated institutional actors, like Michael Burry, have signaled skepticism by taking that high-profile bearish put position. That tells you professional money sees a bubble developing.
That's an interesting historical comparison, but I believe it overlooks the strength of the structural moat Palantir has built. It's a moat that fundamentally differentiates it from historical speculative bubbles. Their unique integration into government and defense creates these sticky, long-term revenue streams that pure commercial peers can't even dream of accessing. Consider the recent substantial £1.5 billion, so approximately $2 billion US dollars, strategic partnership with the UK government. This isn't just a software sale. It's an integration into sovereign military systems, committing London as Palantir's European defense headquarters. When a nation commits its defense and intelligence infrastructure to your platform, you secure a revenue stream tied not to cyclical IT budgets, but to permanent geopolitical necessity.
This is a decades-long relationship, and that level of deep, sovereign-aligned integration acts as a virtually unbreakable, unique competitive moat that, it warrants a different valuation lens.
Okay, I see why you emphasize that moat. It is genuinely impressive how difficult it would be for a competitor to dislodge them. That said, if the strategic future is so guaranteed and the moat so impenetrable, then why are the company's own leaders seemingly taking money off the table at these elevated levels? I come at it from a different way when I'm assessing internal confidence. We need to look closely at the sheer volume of insider selling. In late November 2025 alone, CEO Alex Karp sold, what was it? Approximately 585,000 shares, worth nearly $96 million. And he wasn't alone. The chief revenue officer, Ryan Taylor, also offloaded $9.1 million worth of stock. Now, while these transactions are often filed under routine 10b5-1 trading plans designed to avoid insider trading accusations, the cumulative supply represents a massive, sustained liquidity event. The volume itself creates a constant supply headwind and strongly suggests that management views the stock as fully valued, if not overvalued, at current prices.
Insider selling certainly creates a structural drag. I won't deny that. But we have to be careful not to conflate planned liquidity events with a vote of no confidence. These executives have immense equity holdings remaining. To truly understand the stock's current mechanics, I think we need to focus on the structure of its trading, which brings us to a crucial point about the perceived volatility.
I agree that the market structure is key, and that's precisely where I see the deepest, most persistent risk. I challenge the notion that the stock's price drivers are fundamentally sound. They appear fragile, highly dependent on momentum. We consistently see unusually high off-exchange short volume for PLTR, often exceeding 40% of total daily volume, 43.23% on one specific day in November. This structure, combined with the stock's almost cult-like following, suggests the price is being driven by speculative momentum rather than broad institutional conviction. The price action is simply too dependent on continuous positive sentiment.
That's a compelling argument, though. I think the interpretation of the off-exchange short volume often leads to a false conclusion. When we see 40+% of volume trading off-exchange, it is frequently cited as evidence of a massive, directional bearish bet by hedge funds operating in so-called dark pools. However, this metric is often just a structural artifact of payment for order flow, or PFOF. Market makers internalize massive streams of retail buy orders. And to fulfill those orders instantly, before they have time to acquire the physical shares, they technically sell the shares short to the retail buyer to facilitate the trade. This technical short sale is instantly covered, milliseconds later, but it gets flagged as high off-exchange short volume. A high ratio, therefore, often indicates strong, sustained retail demand. And if we look at genuine, held, short interest, the number of shares actually being bet against, it's low, only about 2.32% of the float. So a classic mechanical short squeeze is, well, it's mathematically unlikely.
I appreciate that clarification on the PFOF mechanics. It's vital to distinguish between a technical short sale and genuine conviction. However, whether the volume is driven by technical internalization or fundamental bearish bets, the consequence is the same. The volatility and reliance on that highly leveraged retail flow remain the core risk. When the marginal buyer is a retail investor using PFOF routing, that flow is just much more sensitive to sentiment shifts or headline news. It creates an enormous fragility in the price base. And this fragility is amplified by options dynamics. That same retail flow you mentioned is also heavily leveraging itself through out-of-the-money call options. And that options market structure is what we need to focus on now.
I agree. The stock is acutely susceptible to options mechanics, but that works in the bull's favor as a powerful catalyst. While a traditional short squeeze may be off the table, PLTR is arguably the single best candidate right now for a gamma squeeze. And this is fueled precisely by that sustained retail base buying massive blocks of out-of-the-money call options. You see, when market makers sell those call options, they have to hedge their exposure by continually buying the underlying stock as the price moves up. This creates a powerful, self-reinforcing feedback loop. Retail buys calls, market makers buy stock, the stock price rises, triggering more hedging, and so on. This is a very real, structural phenomenon that can launch the stock far beyond fundamental valuations. Furthermore, we should probably address the rumors about its capital structure, which also lean bullishly. While some people mistakenly ask about a reverse split, which is for distressed companies, the actual speculation in the market is about a forward stock split, maybe 10 for 1. And historically, lowering the nominal share price on a retail favorite, even if it's mathematically meaningless, acts as a potent short-term psychological catalyst.
That's a compelling point about the gamma dynamics. And I agree, those can generate tremendous short-term momentum. But you have to consider the flip side, the market's structural asymmetry. The same gamma dynamics that fuel these exponential upward moves can and will accelerate declines when momentum stalls. When those out-of-the-money calls expire worthless, market makers rapidly unwind their hedges, exacerbating the sell-off. This isn't just a high-risk, high-reward stock. It's a high-volatility trap waiting for a catalyst to unwind. And while you focus on retail flow and gamma, we have to look at where sophisticated institutional conviction lies. Michael Burry's strategic put buying, 50,000 contracts betting the stock drops dramatically by 2027. That's not a quick flip. It's a deeply researched, multi-year accumulation of downside protection.
This signals that institutional money is placing a high conviction bet on the AI bubble eventually bursting, leading directly back to the multiple collapse that I keep pointing to. They are betting that the laws of valuation gravity will eventually reassert themselves.
I see the Burry position primarily as an insurance policy against broader AI market exuberance, not a specific condemnation of Palantir's unique positioning. So to summarize my stance, while the valuation multiples are indeed high, they are the necessary cost of admission to own a truly essential high-growth, high-margin software platform. The success of the AIP, combined with that deepening strategic moat provided by sovereign interests, justifies this significant scarcity premium. The fundamental momentum is intact, even if the price is volatile.
And my position remains that exceptional fundamentals cannot indefinitely defy the laws of valuation gravity, especially not a 156 times forward earnings multiple. The current price is overly reliant on highly sensitive speculative retail flow. It's vulnerable to external shocks, whether from high-profile bears like Burry or internal supply shocks from insider selling. That extreme multiple leaves investors exposed to enormous risk if the AI narrative shows any signs of losing its spectacular growth trajectory.
So we both agree then that Palantir remains a high-risk, high-reward equity, where the complex debate between hypergrowth and historical valuation is far from settled. It is undoubtedly the definition of a battleground stock. Thank you very much for hearing us. Let us know in the comments what is your opinion, and if you want us to analyze other stocks, don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.